So we're going to get started with economics of insurance. Firstly, insurance is all about risk. A reason why I don't like insurance so much in general is because to me, it feels like they're just exploiting people who are risk averse. So risk averse are people who don't really like risk. And what insurance does is that it comes in as a third party. I know you don't like risk, so I'm going to buy risk off your hands. So you pay me some money, and I'll take this uncomfortable feeling of riskiness. I'll take it out of your hands. I'll keep it for you. If anything happens, don't worry, I'm here for you. And you can rely on me because I'm taking your risk. And you just pay me some amount of money. You don't have to think about this anymore. And that's it. So, because in general, that's the kind of people who purchase who purchase insurance, then these people, because they do want to outsource the risk, they don't really like risk, then they're willing to pay a little bit more to have that taken off of their hands. And what these insurance agents do or insurance companies do, they will aggregate all the different kind of risks. So they buy a lot of different risks from people. They calculate the risk to understand how much will be lost, how much can be earned, how much can be saved, how much can be reinvested, how much needs to be outsourced. And then they can do an entire business model out of it. And to me, initially, I don't like it because it feels like you're just exploiting people who are afraid of risks. But you know what? If the insurance industry has lasted for so long, it just means that the market proves that this industry or this sector is worthy enough for them to continuously exist. So insurance has a value to add. Otherwise, it wouldn't last for so long. So insurance is all about risk. How do you manage risk? How do you calculate risk? How do you outsource your risk? How do you price the different risks? Insurance is all about risk. It's a risky business. So at its core, it's all about managing risk. How do we price the risk and how do we allocate the risk properly so that we don't, as an insurer or as a user or as a person who buys the insurance, you're not overly compensating or undercompensating. You want to price risk quite accurately as possible to the price that you're paying. And at the end of the day, what is risk? Risk is all about uncertainty. Uncertainty, things that you don't know when can happen, you don't know what will happen, you don't know if it will happen. And we want to understand this uncertainty. We call them the probability or riskiness of this uncertainty happening. And we don't like uncertainty. People just do not like uncertainty so much. And so if we can find a probability to this risk, then we find a price tag to this probability, and that is where your insurance comes in. And then you can sell it to someone who is okay with uncertainty and purchase it. So in the economics of insurance, it's what insurers, right? In the insurers, the people like AIA, AIG, AXA, and all these insurance companies, what they do, they will first calculate risk by calculating and pricing the different risks. So as I mentioned, you have a lot of these different people who are afraid of risk. And why are they afraid of risk? Could it be number one, a person with health issues, the family, the parents, the grandparents, the great-grandparents are all smoking. The person itself is also smoking. The person is very unhealthy, doesn't work out, doesn't eat vegetables, very unhealthy lifestyle. And the person wants to buy insurance, health insurance. Okay, so this person knows that his individual health is at risk, and he wants to buy insurance to cover that risk. So knowing all this information, how do we price this risk? The risk of that person who doesn't eat healthy, doesn't exercise, doesn't go out and work out, smokes a lot, very unhealthy inside, versus a person who is like an Olympic athlete that's always eating clean, eating healthy, going to and work out, not obese at all, completely in a healthy weight, really takes care of their health. Now these two people wants to buy insurance. The obese person, the obese unhealthy person, the risk is definitely higher, right? The probability of this person dying from a lot of health issues is a lot higher than the healthy person who takes care of the health with no bad history in the whole family records. So because the risk is different, the price is also going to be different. The price to sell them the health insurance. Because the probability of the obese, unhealthy person going to the hospital all the time because of unhealthy life choices is going to be quite high. And if the insurance company has to always pay for it, then it doesn't make sense that both of them are paying the same price, because the healthy person is probably not going to the hospital at all unless it's a very serious issue that happens once in a year or once in every few years. So the probability of these two uncertainties are quite different. The risk is quite different. So the premiums or the insurance prices is also quite different. So what does that mean? It means that we're just playing with the probabilities and then pricing it. So that's on the individual level. We call them the micro level. In the macro level, what does the insurance companies do is that they have all these different clients, right? All these different people with different health history, health benefits, or health deficits, all buying insurance together. And what they do as an insurance company is where they aggregate all the different risks, all the different health profiles of people. Then they figure out the probability of the risk happening or not happening at all. So maybe 80% of people are healthy, good family background, they take care of themselves, really conscious about health, and the probability of them needing a lot of money for a random healthcare payout is low. Whereas you have 20% of them who are smokers, who are obese, who have a lot of health issues. The family have a long history of health issues and all this kind of stuff. Then you kind of aggregate the risks together and you calculate the probability of how much you have to pay out. And that will be, kept in like a little pool so that anytime it's needed, you don't have to be looking for money everywhere. You can just use that to be paying these people that they have been paying their premiums as well. So that's in general the very basic core. Now, how do they earn money then? Because that's all about pricing risk, right? Pricing what's the probability of payouts. They earn money in two ways. Firstly, it's the premiums. So insurance is not like, do you want insurance? Raise your hand and you come in and I'll insure you. Insurance is more like, this is a theme park. And if you want to come into the theme park, you have to pay your entrance fees. And that's how it works. Before you go into the insurance theme park, you have to pay a fee. And when you take the ride, so maybe it's a hospital ride, you have to pay some fees. You have to co-pay. So maybe the insurance company pays 50%, you pay 50%. Or it could be a different kind of system where you just pay the admission to the theme park and you can take all the rides for free. So that's like full payment for the insurance, for the health insurance. Depends on the insurance package you have, depends on what country that you're from. But in general, they will take money because before you enter the theme park, you have to pay the admission fee. So we call that the premium. And the premium will be judged based on you as an individual, depending on the insurance, right? It could be a car insurance, health insurance, life insurance, business insurance, mortgage insurance, building insurance, different types of insurance. And I told you out of that 100% of money collected, they play with probabilities, right? Not all 100% will be paid out. So where does the other percent of the not paid out go? Where does it go to? That amount that is not actively used to be paying out, it will be reinvested in other areas. So that's how insurance companies, they make money. So they reinvest it in other places. So that was just the general idea of the economics of insurance companies. Now let's go into the different economic school of thoughts or economic concepts in insurance. The first one is the economics of signaling. Signaling is where we use different kind of actions to share or hint hidden information. So things would be, very common things would be like poker. Poker, by raising the cap, raising the prices, or raising your bets, you are signaling, or your action is trying to share some hidden information, something like your cards are very good. So you want to raise the bar, or you want to raise the pot, or you want to have all in. These actions are trying to share some hidden information that you know. Angel investing is another way of signaling, because if you are a startup, you go to angel investors, then you go for a seed round, and then you have round 1, round 2, round 3, or round A, round B, round C. These are different kind of signals, because those investors that put money in you initially during your first few rounds, they show that they have faith in you, that they believe that your business and your idea is good. So that's where the whole angel investing, the previous angel investors are a form of signal to the future investors, saying that my action to put money into this company is showing that I've done my due diligence to this company, and this company is probably very good. So one of these signaling things that that is in the traditional financial world is the Warren Buffett halo. So basically, any company that he invests in or the company invests in, there is just a premium to it because his signal, so Warren Buffett's signal is just so strong that it will increase the price or increase the valuation of the company that he invests in or he is putting money in. The other one is also IPO. So IPO is where a company is listed on an exchange, and before IPO starts, usually they also have a lot of institutional buyers or institutional investors that are interested to be purchasing before an IPO. And that's where there is a whole mechanism behind, which is quite fascinating. And there is a lot of signaling going on behind the scenes before the IPO thing. So that's the whole economics of signal. And in the insurance space that we want to talk about, we're looking at pricing as a signal, where pricing is a way to show and share hidden information. Because in insurance, just now we talk about insurance is very opaque information, right? You can't really tell a lot of different information because all the information is hidden behind the scenes. It's all opaque. So we use pricing as a signal to be sharing what the pricing is or what hidden information that we want to subtly bring across. We do that with pricing. The second economics principle is the economics of moral hazards. Just now, when we talk about signaling, it's about the actions to show hidden information. In moral hazards, it's the problems caused by hidden actions. So hidden information and hidden actions are different things. Hidden information is usually before the thing occurs. So before you show everything in poker, or before you show your cards, those hidden information occurs before the event happen. Moral hazard is usually when something happens. Moral hazard is the actions after the thing happens. So this, for example, you drive a car rental and insurance. If you book a car and let's say you book a car and you have insurance for the car as well. So you're less likely to drive cautiously because you've bought insurance for the car already, and if the car is damaged, the insurance will cover for it. So that's so these are problems caused by hidden actions, moral hazards. So this is inefficient because, once again, people are not being 100% transparent, 100% truthful. In signaling, a lot of information is hidden. Maybe because you can't tell, maybe because it's difficult to tell, maybe it's just really, really unavailable, or you just can't tell, you can only show. So there's problems with transparency. In moral hazards, it's hidden actions that happens after the event has happened or after the contract is being signed, the insurance is being bought. So this is where inefficiency comes in because it's not 100% transparent again. So what we want to do, we want to increase. So with the economics of moral hazards, one of the problems is that because the burden is being shared, right? Because I bought the car insurance. If anything happens to the car, I know I have to pay, but the other guy also has, the insurance guys also have to pay. So I am okay with increasing my exposure to risk because the burden is shared anyway. So you are more likely to increase your risk exposure because the burden is being shared. Now, is this good or bad? It's quite difficult to say because on one hand, to increase risk exposure sometimes could be good in some situations. But in general, to increase risk exposure because you're not bearing the full burden because someone else will take the burden if bad things happen. That's not what we want. That's not a very efficient model because we're going to have a lot of losses. We're going to have a lot of debt rate loss. We're going to have a lot of efficiency losses. So what can we do to minimize this moral hazard issues? And in insurance, one of these is usually to do co-payment. So instead of the insurance company covers for everything, the insurer and the insurance company pays together. So they share the payment. And lastly, is this thing called the PA relationship, the principal-agent relationship. At the end of the day, insurance is all about this entire thing called the principal-agent relationship or the principal-agent model. You've got two parties. You've got the principal, you've got the agent. In general, remember I told you just now that the insurance are the agents of me because they have to take care of me, spend my money on my behalf properly so that when something happens to me, my insurance can cover. So principal agent is where you have two parties, a principal, like the main person, and an agent that works on behalf of the principal. And when principal agent models and principal agent relationships can be very helpful when we align all the incentives together. When one party is doing something that benefits the other party also benefits the first party, and they work together hand in hand. Incentives are aligned, and this is very good to achieve the best objective that benefits both parties. It's efficient. What happens in this situation, a bad thing that happens, is where one will be exploiting on behalf of the other. So going back to the example of the 2008 crisis, right? A lot of insurance companies failed, a lot of companies defaulted, and that's because their incentives were not aligned. For those banks, the incentives were the bank's own profits and benefit and profit margins and bonuses, and they were investing in very risky assets. And remember, we're talking about life insurance. So at the end of X years of your life, you can get some money back and until you die. So these life insurance are basically these people's entire life savings. So they are the principal, insurance are the agents that help to reinvest for these principals, right? These regular people with their life insurance in the hands of insurance agents. And these insurance agents were not tactful. They're reckless in their investment, and it resulted in bankruptcy with a lot of bad investment. And the loser in this case are the principals because they just lose all their money. So this is where incentives are not aligned and one party exploits the other. So what we want to do, we want to increase the alignment of incentives. We want both parties to be aligned together. We want both parties to be benefiting each other and working together so that it helps each other to grow. So in the crypto space, it's quite difficult to define the principal-agent relationship because we have anonymity, we have a lot of things that it's quite fluid, and there isn't regulations yet. The entire space is still experimenting and growing. However, one thing that really binds the entire crypto space and DeFi space together is smart contracts or data. With smart contract, it's easier to rely on the code to underwrite the different risks available. And so in the crypto space right now, a lot of the insurance that we see is either smart contract insurance, so something that you can absolutely verify with code, or data heavy insurance. So you can use external data, or you can just use data in general to be verifying your errors, your inefficiencies, your different compensation that needs to be done. So with crypto, we can streamline this inefficiency a bit, but we can't resolve everything, not right now. So we can do things bit by bit in small little steps. And lastly, as I mentioned, the economics of this entire insurance industry is all about numbers. It's about aggregating all the different kind of risk profiles of people, because some people are riskier, some people are risk-loving, some people are less risk-loving. You aggregate them together to find out what's the probability distribution of the different risk profiles that you have. Then you can bet on the long tail risk of these. The tail risks are basically things that wouldn't happen so often, but when they happen, it's going to be quite significant. So they will bet on these different tail risks happening, and low probability, but still possible to happen. This can only be done when you have a lot of numbers. So we call this the law of large numbers. This is used very much in statistics. And in insurance, it's all about statistics. If you're interested in the industry, you should check out actuarial science, because it's all about looking at numbers and looking at data to be pricing risk. I talked a lot about pricing risk in monetary terms. It's not exactly, I have a check box and I have this different, like the risk name starts with L. That's a good thing. Or the risk covers 3 points. Okay, that's a good thing. And then you just price the risk that way. No, there are a lot of different data and analysis that goes into it. So data is really, really important. And this is where crypto can perhaps become a small little breakthrough, because we're talking about a distributed data set that cannot be modified, that cannot be edited, that cannot be changed. So you can aggregate this trustworthy data once it's verified, and to be inputting it into your system to be calculating the risks. So that's one of the very interesting potential as the system continues to grow, as more people come in on board, and as we understand a little bit more about the risks involved and how to price them.